Hey everyone, this is Mike from Hummingbot, and this is the fourth video in our Market Maker school series, and this one's on risk management. Now, managing risk is one of the most important aspects of market making, and today I'm going to show you what the main risks are and how to manage around them using various features within Hummingbot. So let's get to it. First about Hummingbot. Hummingbot is an open source project that helps anyone build and run crypto trading bots. It's open source, that means it's free, and all the code is publicly available on our GitHub. We launched about a year ago, and today we have a pretty large community of traders and developers who are contributing to the project, fixing bugs, and overall creating something that everyone in the world can use. Now, when we talk about risk from market makers' perspective, what we mean is that as a market maker, you profit from buying low and selling high. And so the ideal type of market that you want to trade in is one where it's range bound, where the market is kind of going up, it goes down, it goes up, it goes down, and it kind of like trades in a certain range. And so by corollary, that means that the type of markets where you're going to lose money is one where the market's going to go up a lot or down a lot. And that's due to something called adverse selection, which basically means that people in the market know more than you do, and they are taking advantage of the fact that they have better information. So here's an example of that. Let's say you're market making and the price goes up. When the price goes up, because you're placing both a buy order and a sell order, your sell orders are going to get hit a lot more often, right? Because if you have a buy and a sell, when the price goes up, first your sell order gets hit, you replace those orders, it gets hit again and again and again. And so what happens is if you start with a balanced portfolio, eventually you're going to be selling more than you're buying. And so eventually you'll have a lot more of the quote asset than the base asset. Now, since price is measured in the base asset, that basically means you're accumulating more of the asset that's going down. You're accumulating more of the asset which is going down in price because the price of the base asset is going up, but you're selling that asset and acquiring the quote asset. Conversely, let's look at what happens when the price drops. When the price drops, that means you'll be buying more than you're selling. So as the price goes down, your buy orders are the ones that are constantly being filled. And so in this scenario, you're accumulating more of the base asset and you are losing more of the quote asset at a time when the price is going down. So you're accumulating more of the asset whose price is going down. So this is to show you that as a market maker, your primary risk that you have to manage is your inventory risk as the price in the market changes, and how you deal with that inventory risk in the face of changing markets is really the essence of market making. Now let's look at some markets. This is the Zilliqa Tether market on Binance over the past 7 months. This is a market that we rewarded in our liquidity mining program, where Zilliqa sponsored a reward pool that allowed anyone in the world using Hummingbots to make a market for Zilliqa and earn rewards. Now, the Zilliqa market from December up until about May was a very ideal market for a market maker. Despite kind of like the big drop on Black Thursday, March 12th, not counting that, the rest of this market was very much a range-bound market. You can see that Zilliqa traded kind of like, in a 0.004 to 0.008 band, basically for like 7 months. But in May, there was this trend in the market, and Zilliqa, you can see the market changed significantly. And Zilliqa went up in price and down in price. So the first part of this market was a very good market to be a market maker. And the second half of this market was a more challenging scenario. Now, you can still make money because the spreads were probably much wider during this aspect of the market. However, the need to actually manage inventory risk, the need to respond more dynamically to market changes is what's necessary. And we also saw that a lot of our newer users did actually lose money when they were market making during this phase. Conversely, if you look at another market that we were rewarding, this is the iExec Ether market. This is actually the exact same time period. So from December of last year to June of this year, and you can see this market was a much more appropriate market for a market maker, a better market for market makers, because this is a market which basically hovered in this range of between 0.002 to 0.004 for the last 7 months. And there's a few reasons for that. iExec and Zilliqa are two different tokens with different communities, different things going on with their token prices. But also, the quote asset here is Ether, whereas in the previous market it was Tether. And since RLC is an Ethereum token, it stands to reason that the RLC ETH market will be less volatile overall than the Zilliqa Tether market. So market selection, as we pointed out in the first video, is a very important part of market making, to make sure you pick the right markets. But then the problem still exists where you don't know what a market's going to be like when you first enter it. You can observe what's happened in the past, but you don't know what's going to happen in the future. So that's where different features of Hummingbot come in that can help you manage how your bot behaves when the market starts trending. So here are 5 ways 5 features of Hummingbot you can use. I'm not going to go into all of these in a lot of detail in this video, but I will do so in future videos. But I will kind of describe how each of these work. The most basic one is a kill switch. This is a global parameter that allows you to stop the bot when performance reaches a certain level. This level can be either positive or negative. So you can set your bot to stop trading, let's say if you hit a 5% profit, or a negative 5% loss. Overall, we have users who use it both ways to either protect against gains they've made, as well as to prevent losses when the bot is running. So every so often, we recommend adjusting this parameter to make sure that you're either locking in profits or preventing losses. The second parameter is called ping pong. This is probably the most basic way that you can manage inventory risk. If you saw the last video that we did on building a strategy, this was a parameter that I used in setting up the bot and to protect against inventory risk. The third way you can do it is something called price band. Price band is where you set a buy and sell. We basically only buy and sell offers within a certain range. And what you're saying is that I think the price is going to hover within this range. If it goes above the range, I only want the bot to place sell orders. And when it's below the range, I only want the bot to place buy orders. Now, the tricky part of price band is that because prices move quite constantly, you may have to update the price band settings on a regular basis to make sure that it matches where the market is trading. And the last 2 parameters are a little bit more complex. We would recommend them for more advanced users. One of them is called inventory skew, and this is where you're trying to hit a certain target inventory percentage, and as you deviate from that percentage, the bot adjusts the buy and sell order amounts to try to get you closer to that target percentage. And finally, we have hang orders. This is more of an advanced strategy where instead of canceling orders, you leave them hanging on the order book. And the thinking there is that when the market's kind of trending up, you're buying, but by leaving the sell orders out there, and if the market does kind of come down, then those sell orders will get hit, and you actually do end up buying lower and selling higher. Now, so those are just 5 ways to manage inventory risk. We also have set these up so that you can use combinations of them. So, for example, a lot of people use a kill switch parameter, but they also use hang orders plus ping pong, or they might use inventory skew plus hang orders. So these are all different combinations of parameters you can set. And I think the best way to do that is really through experimentation in paper trading mode to find what works for you, or by live trading and using a small amount of capital for experimentation. Overall, market making is a very nuanced field where where making money is not so much about being right, but more like positioning yourself and to take advantage of market oscillations. So I recommend you place a lot of thought into how you set up your bots and do a lot of research, because that way, by learning from every single time you run the bots and learning about how the market is reacting to it, I believe that anyone can become a successful market maker over time. So that's about it. And in future videos, I will go into more detail about each of these different parameters. Thanks.